What is financial modeling? Financial modeling is the use of spreadsheets to project a business's financial performance for planning, budgeting, or investment decisions. Are you building a business, raising funding, or evaluating investment opportunities? If you answered yes to any of these, then understanding your financial prospects is crucial, and this is exactly where financial modeling in Excel becomes your most valuable tool. Diving deep on financial modeling, it is a structured process where the expected financial performance is derived based on a set of assumptions and calculations. We input assumptions, use formulas for the calculations, and then predict how a company will perform in the future. So the better the analysis and the assumptions used, the more accurate the prediction ability of the financial model, making it essential for budgeting, fundraising, business valuation, and investment analysis. The three core concepts defining a solid financial model are: first, it must be a rational analysis, involving a clear and thought-out steps, avoiding non-essential or repetitive actions. Second, it must reflect the financial logic of a business in terms of its calculations, analyzing and describing how revenues are earned and how costs behave, painting a clear picture of the business financial engine. And third, it must be based from an educated best guess of its assumptions. Models are estimates based on assumptions and are not guaranteed due to numerous variables and uncertainties. Hence, it is important to make an educated best guess to reach the most informed projection of future performance. So, why learn this skill? Because financial modeling helps build business plans and budgets, determine funding needs, analyze risks, and guide strategy with data. When do you use it? At every stage: startups, growth, maturity, and essentially in fundraising, mergers, and bank negotiations. Who uses Excel models? Well, a wide range of professionals: financial analysts, consultants, business owners, investors, real estate developers, and bankers, each with different goals but one shared tool. Moving forward, with so many software tools out there, why do professionals still rely on Microsoft Excel? Well, for one, it is easy to use. Most businesses already have Microsoft Excel installed, eliminating the need for costly new licenses or specialized software. It is widely adopted, as it is globally recognized and used across different industries, regions, and institutional sizes, meaning most users have some familiarity, making models easier to share and navigate. It has formulas and features, boasting powerful functions that expertly handle varying assumptions, inputs, and complex scenarios. You can create custom models with if formulas, sum products, and more. And lastly, it includes charts and visuals. Excel lets you turn raw data into graphs and dashboards that tell a story, helping other users to easily understand data with visualization. Now, to build an effective and robust financial model in Excel, mastering the right formulas and functions is absolutely essential. These tools automate calculations, analyze data efficiently, and create dynamic projections. While Excel has many, here are some commonly used examples. If function, for logical tests and setting parameters for different scenarios. SUMIF, sum product, for powerful aggregation and conditional summing. Average, MAN, max, round, for statistical analysis and data manipulation. And VLOOKUP and index plus match, for efficiently searching and retrieving specific information from large datasets. Now, beyond formulas, a strong financial model is a thoughtfully constructed framework with several core components. Assumptions: these are your well-defined inputs based on historical data and future expectations. Operating model: it forecasts a company's operations, detailing revenue sources, direct costs, and operating expenses. Financial schedules: the projected income statement, balance sheet, and cash flow statement, all interlinked to reflect financial activities over forecasted years. As well as financial ratios and metrics, the model must include calculations like leverage, liquidity, profitability, and efficiency ratios used to analyze both historical and forecasted performance, highlighting strengths and weaknesses, as well as key measurements like NPV, IRR, and payback period, which reveal specific financial information not always apparent in the main statements. Finally, financial models come in many forms, each specifically tailored to a particular business purpose, industry need, or level of financial complexity. There are two main types, which is the basic financial model and the advanced financial model. For basic financial model types, these are foundational tools for planning and analysis like a three-statement models, which is the most basic type. Discounted cash flow, DCF, models, used to estimate a company's or project's value based on expected future cash flows. Budget and forecasting models, designed for monthly or quarterly figures, outlining what the business wants to achieve to plan growth strategies. As well as startup models and investment analysis models used to evaluate the financial viability and return potential of investment opportunities. And for advanced financial model types, these are complex transactions involving initial public offering, IPO, models, which values a company preparing to go public. Merger and acquisition (MANDA) models, simulating the financial impact of combining two companies. Leveraged buyout (LBO) models, which evaluates the acquisition of a company using high levels of debt. Other advanced models include consolidation models for combining units and sum of parts valuation models for valuing a company based on its divisions. And lastly, while a financial model is incredibly useful, it is only as good as its builder and the assumptions fed into it. To ensure reliability and user-friendliness, be vigilant against these common mistakes. Using incorrect financial history, always ensure your historical data is accurate, up-to-date, and from the correct financial period. No logical structure. Arrange worksheets logically by functionality, making them intuitive for any user. Inconsistent formats. Use identical column headings, standard fonts, colors, and border styles for clarity and usability. No error checks. It is crucial to utilize Excel's built-in audit functions and create dedicated error check sheets to quickly spot and fix calculation errors. Lastly, lacking visual presentations. Failing to incorporate charts and graphs can hinder comprehension, as visuals paint a much clearer picture than raw numbers alone. Mastering financial modeling in Excel is truly a powerful skill. It equips you to evaluate new business ideas, secure essential funding, plan robustly for the future, and consistently make sound, data-driven financial decisions. With practice, attention to clear structure, and the right Excel functions, you won't just crunch numbers, you'll tell a compelling, strategic financial story for any business. If you found this guide helpful, please give this video a thumbs up, subscribe to our channel for more valuable insights, and hit that notification bell so you don't miss our next video. Share your thoughts in the comments below. What aspect of financial modeling are you most excited to learn next? Thanks for watching.